All right, let's dive into something really fascinating from the world of finance, the IPO Pop. You probably heard about it, that huge, sometimes insane jump in a stock's price on its very first day of trading. So today, we're going to crack the code and figure out why on earth this keeps happening.
So picture this, a fast-growing company decides it's ready for the big leagues. It goes public through an IPO, opening itself up to investors all over the world. It's a massive moment, but almost like clockwork, something really interesting happens the second its stock hits the market.
Get a load of this. Back in 1999, at the absolute peak of the dot-com bubble, the average IPO shot up by 72% on day one. 72%. That massive surge is exactly what we call the IPO pop.
Now, the technical term for this is the first-day return. It's really just a simple way to measure how the market feels about a new stock right out of the gate. And a big positive return, well, that means investors were scrambling to get a piece of the action.
And that leads us to the big question, the central mystery of all this. I mean, if your stock jumps that much, it means you could have sold it for way more, right? So why are companies seemingly leaving millions, sometimes billions of dollars on the table? It doesn't seem to make sense.
To really get to the bottom of this, we first need to do a super quick refresh on what an IPO actually is.
Okay, so at its heart, an IPO is just how a private company raises a whole bunch of money. It does this by selling shares, which are just tiny little pieces of ownership, to the general public for the very first time. And just like that, it's no longer a private club. It's a public company on a major stock exchange.
So you gotta ask, why would a company take this huge, complicated step? Well, it turns out it's not just about raising cash. There are some very smart, strategic reasons behind it.
It really boils down to four key things. First up, ownership. This is the moment founders and early investors can finally cash in on their hard work. Second, it's operational. That new money is fuel for growth, for building new factories, or hiring more people. Third is financing. Once you're public, it's often way easier and cheaper to borrow money. And last but not least, marketing. An IPO is a huge publicity event. It puts your company on the map.
Okay, with the basics down, let's get back to our puzzle. This whole underpricing thing has had economists and financial experts scratching their heads for decades. But over time, they've come up with some really smart theories that start to make it all make sense.
Let's start with our first clue, which I like to call the information gap. And it's simple, really. When it comes to an IPO, the company and the investors are absolutely not playing on a level field.
The fancy term for this is information asymmetry. Just think about buying a used car. The person selling it knows every rattle, every weird noise, every little thing that's wrong with it. You, the buyer, you just know what you can see. It's the same with an IPO. The insiders know the business inside and out, but investors, they're on the outside looking in.
So how do you get those investors, the ones who don't have all the info, to take a leap of faith and buy your stock? You give them a deal. You offer them a discount. That underpricing is kind of like an insurance policy for them. It's a reward for taking a risk on your company.
Now, our second clue suggests that maybe this whole IPO pop isn't an accident at all. What if it's a message, a carefully crafted one?
This brings us to something called signaling theory. Here's the idea. A really high-quality company knows it's going to be successful in the long run. So it can afford to underprice its stock. Why? Because that huge first-day pop acts like a giant flashing sign to the entire market that says, hey, look at us. We are a top-notch company, and you're going to want to be a part of this. It's how they separate themselves from the crowd.
And here's the really clever part. That money they left on the table, it isn't really lost. By creating all this buzz and a successful IPO, they build an amazing reputation. That allows them to sell more shares down the road at a much, much higher price, easily making back that initial discount, and then some.
Okay, our final clue zooms out. It looks beyond just the company and its investors and instead considers the entire environment, the rules of the game in the market where the IPO is happening. This is what's known as institutional theory. It basically argues that the size of the IPO pop can depend a lot on the country you're in. If you're in a market with really strong legal protections and strict rules, investors feel pretty safe. You don't need a huge pop to attract them. But in a riskier market, you might need to offer a bigger discount, a bigger pop, to convince people to jump in. So you see, when you put all these clues together, the information gap, the need for a company to send a strong signal, and the rules of the local market, the puzzle starts to come together. And this isn't just theory either. We can actually see it play out in the data from all over the globe.
Which leads to a really interesting question. Just how much do those rules of the game actually change the outcome? How different can these IPO pops be from one country to another? Well, you're about to see.
Let's start with China. The average initial return for an IPO there has been a completely staggering 165%.
Now compare that with Russia, where the average first-day pop has been only 5%. The difference is just massive.
And this chart really tells the story, doesn't it? It's basically a perfect illustration of that institutional theory we were just talking about. You can see this huge range across all these different countries, which proves that the local environment, the regulations, the investor confidence, it plays an absolutely critical role.
And even if you just look at one country, like the US, you can see how things change over time. Look at that dip around 2008, during the financial crisis. And then look at the huge spike in 2020, when the market was on fire. It just goes to show you that timing and what the overall market is doing are also huge pieces of this puzzle.
So let's go back to our original question. Is the IPO pop a bug in the system or is it a feature? Well, all the evidence seems to point to it being a feature. It's this really sophisticated mechanism companies use to manage risk, to signal their quality, and to play by the rules of whatever market they're in. It's not about losing money, it's the price you pay for a successful entry into the public world.